Hello, I'm John Kreidler. Welcome to This Week in the Markets. This week, the bond market was front and center. The 10-year is now at 4.25%. What should we make of that? Well, last year was at 5%, and last month it went all the way down to 3.6%. So in essence, it's just retraced about 50% of the move from 5% to 3.6%. Typical and normal for something that's being traded, interest rates, swaps, a stock, commodities, whatever it might be. If it stays in this range, around 4.25%, that would be typical and something to be expected. The bond market does, however, have to factor in growth expectations, which are at 3% for GDP, according to the Atlanta Fed, inflation expectations that are going down, according to the Federal Reserve, but also the increase of supply of issuance to service our debt. Right now, the Department of Treasury just published a report talking about servicing the debt is at 18% of the budget. Factor in that the defense budget is 18% of the overall too. Basically, over 1/3 of the federal budget is either defense or servicing the debt. It remains to be seen if that's sustainable. Going into the election, the policy of Vice President Harris or former President Trump will be factored into the bond market going into the first quarter of 2025. And it remains to be seen if the bond market will look to increase rates to temper down expectations by both the Federal Reserve to cut rates or to the Trump or Harris administration in order to have their proposals for their budget. That all remains to be seen. I'm John Kreidler. This was This Week in the Markets. Have a great week.